Hey guys, we're live. We got Kevin Green with us today. It's after hour market party with Kevin. So we've been doing the commodity port for a while. Kevin's had a busy last couple of weeks, so we wanted to get Kevin on. If we get a chance, we want to bring Kevin on to talk to you guys. So I know you guys are going to ask, what's Kevin thinking about this? What's Kevin thinking about that? You've heard what I've said this week. You've heard what Sam's been saying this week. But Kevin, what are you seeing out there? The commodities have been pretty wild in the last. I mean, year to date. Year to date, we're looking at, and basically everything across the board, especially coffee. Coffee up 33%, copper up 16%, natural gas up 16%, platinum up almost 15%, soybean oil up 13%. I mean, it's pretty endless and pretty bullish unless you go down to the other end of the spectrum, which are things like orange juice. Not many people are trading it. So most of the things that people trade pretty heavily are doing pretty well. So anything you're looking at that you're really excited
Yeah,
about?
yeah, and I appreciate it. Yeah, everything's been kind of a little bit busy here, so we're doing this live. So if you have any questions, comments, or whatever, put them in, or tag me on X or whatever. We'll go through them. So let's kind of go step by step. I'm going to go with, let's say, popularity. I'm going to stay away from the softs though, but my popularity here. Let's talk about gold. Okay, so there's been this huge thing about gold here. I will try to actually flip you a chart, but maybe it won't work out. But let's see. Let's talk about gold. Okay, obviously gold has had a phenomenal run to the upside, right? And rightfully so. You have seen some uncertainty when it comes to policies here in the United States for the Fed. Obviously, we had a very hot CPI print today. I don't think that was really surprising to see what that CPI print came in at, just given the fact that we did see that Arctic blast just as a whole was really pushing up prices for diesel. When you're looking at prices for gasoline, oil saw that spike hitting up to $80 or so. So a lot of things were actually kind of taking place in that sense for the month of January. But and I'm going to DM this to you here real quick. If I don't know if you're going to be able to pull it up, but this will kind of tell the story for gold, because I think this is actually very interesting. So if you look at gold, and a lot of people have their commentary around gold, what's actually happening with this market right now. But I think if you are a commodity trader, you got to look under the hood at all times and see exactly what's actually happening here, because sometimes price action, even though price is king, may tell you a different narrative than what's actually happening within the other underlying. So for now, at least since January 24th, what we have actually seen is a reduction in open interest when it comes to gold contracts, just in general. If you look across the curve for these future contracts, the open interest, you aggregate them up, you can look at the net change either to the upside or downside. The CME has a really good tool about this. You can follow me on X, KG Bull and Bear, and you can check out these tools. They're for free. But here's the thing. Open interest is going lower, prices are going higher. So an educational point here for futures, prices going up with open interest going up usually signifies and is signifying the fact that longs are getting into the market, net long. Okay. Prices going up, open interest going down. That signifies short sellers are buying back contracts and closing their contracts. Okay. So even though price is going up, you can still have this kind of squeeze situation taking place. On the sell side, market sells off, prices go lower, volume goes up, new shorts entering the market, prices go lower, open interest goes lower, buyers that have been long are closing out positions. So you got to know those four fundamental things when you're trading futures. And here's the reason why. What we have seen since January 24th is a massive increase in the amount of deliveries that have been requested by shorts in this market. So a short seller in a futures contract has the right to deliver. It's different than equity options, where the buyer of any equity option has the right to take action. In futures, when you're looking at futures themselves, the seller has the right once we hit first notice day. So what has occurred is the February contract, which had a lot of the trading volume and a lot of open interest, the bigger banks, the financial institutions, the JP Morgans of the world, which JP Morgan is the biggest trader of gold in the world right now. The JP Morgans, the UBSs, you name it, Deutsche Banks, they've actually been issuing and requesting that their short contracts that they actually are able to exercise those or deliver them. Now, why would these banks be short these contracts? You short futures if you're an institution, if you're a producer or a hedger, you short futures to be able to hedge downside risk of price because you have exposure to the actual physical contract, physical commodity. Okay. So what we are seeing now is these orders going in, they're saying, hey, we're short this. We want to be able to exercise this. We want to be able to deliver the physical commodity. Where are they getting this physical commodity? From the London Metals Exchange, the LME. So there's actually a physical transfer that is taking place right now between the LME. All of that's now coming into the COMEX gold warehouse out in New York. And the reason why they're doing this is because they also have customers, very large customers. Very large customers. Let me say that again. Very large customers, okay, that are also putting these orders in. And I did this 2 days ago. I don't know what it is now, so it might have updated. But net, if you kind of look at the house accounts compared to customer request, if you look at it at the aggregate, it's net 12,500 contracts, give or take, meaning that the house accounts, 12,500 contracts still have things that they can kind of move around here. But producers are covering their short positions, not by buying them back, but by exercising or basically assigning those contracts. What you're seeing here is the gold warehouse stock. This is actual physical inventory at COMEX. Now, we have not seen a trajectory like this for the amount of physical in a very long time. Last time that we saw this was COVID-19. Literally, the start of COVID-19, like a week or 2 weeks before COVID-19 really hit the US equity market and really kind of shut down the market as a whole. Massive spike. Why are they repatriating? We had this move to the downside. LME was kind of taking those flows. Now we have a rapid spike. I believe this chart is also dated too. It's 1 day old, right? So we'll have updated numbers today, but we're probably very close to COVID high peaks. Why do I bring this up, Jason? To bring this all full circle here. If you remember what I was just saying, prices going higher, open interest going lower. The open interest is going lower because the producers are closing out their positions. The producers are closing out their positions because they're getting the physicals and delivering the physicals. Now, the physicals can also be certificates, but just for the sake of argument, okay? If they're delivering the physicals, what is the need for those producers to step back into the market and hedge? What are they going to hedge? Do they need to hedge? Probably not, right? If they're delivering. So producers increasing shorts, they have a reason to do so because they have to hedge their inventory of the physical that they have on their books. They unwind or buy back or close out those short positions when they do not need the hedges anymore or they have some profitability. And usually when you start seeing that, that's, in my opinion, I'm not calling tops, my opinion, late cycle. What is actually seeing an increase in buying activity right now? Manage money. And you know me and manage money, okay? Manage money. The ETF flows that are out there, those that are fund managers, they're getting long gold now. They've been getting long gold for the last month. Those are usually the easier ones to also fade, right? They don't have the sticky reason for prices to stay elevated. So what I'm saying is just be very cautious. Can gold continue to rise? Yes, there's a lot of uncertainty, right? A lot. News flow over on a dime. The events that were going to happen this weekend, we'll talk about that here in a second. Anything can happen. Gold can continue to move higher. But the structural difference that we are seeing right now when it comes to producers and their physical positioning is something that's general. I would say, let's call it cycle behavior. Somewhat generational, right? COVID-19 was a generational type of event. This is a similar thing. Let me, I'm gonna capstone this. I know I'm talking a lot. Capstone this real quick. All right, so what's now the active contract that we have for gold? Because the February contract probably ceased to exist trading in literally amount of days, couple of days. There's only maybe 4,000 in open interest, and brokerage houses usually will not allow anybody to go long those contracts because of the fear or the risk that they could be assigned. So anybody that's else that's staying in those February contracts are institutions and they're ready to go, and they know that they're probably offsetting that by physicals. Around 6,000 contracts. I already told you the net. There is a March contract. March contract, not active. No one trades it. So open interest there, last time that I checked, was like 4,500 contracts. So the next one that's active is actually the April contract. So we have something called first notice day, is the first day that these these sellers can actually deliver these, or put the intention out there that they want to actually deliver the physical. That first notice day, if I'm not mistaken, is February 28th. So right now we're kind of locked up when it comes to the physical delivery. This situation that we just saw last 2 weeks, we're kind of locked up right now, just because there's not enough volume and flows for the March contract, and then they're locked up until they can actually hit first notice day. So knowing that that's the environment, knowing that the price action was moving to the upside because of that first notice day event, you can make the case that maybe this is one, late cycle type of behavior, two, volatility for these products might go a little bit lower. And then three, maybe we do actually see a little bit of a pullback unless managed money can pick up the flows. Now, once February 28th comes around, February 29th or whatever, leap year or whatever, once that comes around and you start seeing those deliveries, intentioned delivery notices ramp up again, that's your tell. That's your buy signal, not a recommendation, but that could be an influencer for prices continuing to advance. But if it does not, then I think that's where you kind of have a problem. So, man, it's been a while, and you can see that it's been a while. So I'm going to kick it back over to you. I'm not calling the top here. All I'm just saying is be very cautious, because we've seen this before, and the reaction after this all settles out usually is price action moving to the downside aggressively. And I would look at the 50-day moving average as your first area of support.
Okay, we're good. So sorry, my mic went out for a second, but I'm back. But no, it's good to have you, man. I'm always excited to have you kind of dig in and like let's talk about what's actually happening here, what Kevin's seeing. Because yeah, like if I bring in another person that's price action based and big picture based like me in the very long term macro trends, it's just going to be an echo chamber. I'm going to say yes, I'm long gold. They're going to say yes, you got to be long gold, and that's going to be the end of it. Why I like to have you here is having the conversations about what's inside of it, because to me, it's the same thing. Like I look at all these numbers as well, just like you do, but kind of piecing it together in a way that you can put out to people that, don't have the same time frame as me. That's incredibly important. I think that's what's very cool about what we do here, covering different time frames. Yeah, like you said, I'm long term in gold. I have a very long term trend system. We're looking at anything from 6 months to a year for most of our trades. Being long gold's pretty good, great. We're in an uptrend. I like to walk away in uptrends. However, like Kevin's talking about, when things get off sides, and you guys hear me talk about this all the time as well, which is when things get offside and the positioning gets too one-sided, and managed money starts to get very interested. It's all dumb money at the end of the day, but there's people that you want to fade and people that you don't. You'd want to fade the managed money over everything. So, Kevin, let's hop into, I'm sure people want to know about
I'm
silver.
sorry. Can and I'll talk about silver real quick. 50-week moving average. I'm sorry, not 50-day, 50-week moving average, 25.28.
Okay.
Sorry.
No worries. So silver, let's take a look at silver, again, get an understanding what you're seeing here. Because are you thinking something similar, or are you thinking it could be a little bit different? Because I think my thoughts on it is I think that gold will probably slow down at some point. If this is a real commodity cycle and we're actually going to see the commodities move this year, and once again, that's a 50-50 still. We don't know that for sure just yet, but there's some confirming signals. But I would think that gold will calm down at some point, and silver's really got to move. But what do you think about silver? Same story, positioning does look pretty similar, or do you think it could start to catch up here?
So for the silver trade, okay. So silver is already seeing the same situation, a little bit more aggressively, but there's kind of a reason for that, right? So, when you're kind of looking at what else can actually run, I think for silver, you got to trade it on the technicals first, rather than maybe looking at when you trade silver, use the technicals more than anything, because silver is usually technically driven. Silver usually does not see a lot of irrational trading behavior, usually. Okay, so when I'm looking at silver right now, I'm looking at 30, I'm looking at 32 and a half, 32 and a quarter is your first area of resistance. Obviously looking at that $34 level. It does appear that it is trying to coil up here a little bit, but the 50 period moving average is a lot closer, right? So the 50 period moving average, if you do have a pullback, is sitting only at around $29.93, right? So its check back is a lot easier for a check back bounce and then rip higher, whereas gold has a long way to go, right? You're talking about a couple $100 to go to the downside here. I still think that it's a, the reflation trade. It's a China trade for sure. It's a tech trade and growth trade. But once again, I kind of traded on the technicals. So I would say that the more bullish narrative for silver is going to be more economic growth related, rather than kind of just what we are seeing right now with gold, where gold is the inflationary hedge, it's the uncertainty, it's the dollar hedge, right? Gold's been utilized for a lot of the central banks are buying it as well. So kind of two different type of dynamics that are there. There is some tariff risk when it comes to silver though. And so, that might be a little bit more of a harder trade for right now, but silver looks like it's trying to coil up. It's trying to at least hinge here, and you just kind of have to go with these dips, these cup and handles. It's all silver is. Silver just trades in cup and handles pretty much the whole time. So I would just put up a MACD up there on the weekly and look at an RSI on the weekly. Look for bearish divergences, bullish divergences, and kind of trade it that way. But I'm not saying I'm negative on the silver side of the equation, but you need China to step up, and China PMI data is just ain't looking great. Like it's not to the expectations that I would have expected here. So that's my outlook, or not my outlook, but my thoughts when it comes to silver. Can it rip? It could, but you're going to need some other additional factors that are there fundamentally for it to do so. But this is one of those breakout areas.
Yeah, as my trend spider just dipped on me. So, but let's move on to the next one. And you mentioned it a little bit. So if we're looking at the commodity trade, we have to look at China. Everybody's talking about China right now, which worries me because I've been very bullish on China. Now everybody all of a sudden is extremely excited about China, which makes me worried. So if we're looking at China, how does this kind of, and I want to talk to you about some of these other countries too in here. So feel free if you want to jump into South America or anything else, feel free. But how does China really play into this story? A lot of people don't know the fundamentals behind it. And so why don't we walk through the fundamentals behind China and talk about why this could also put some pressure on this commodity trade that we continue to talk about.
Yeah, so the China story right now is AI driven, not so much macroeconomic data that's coming out, right? Like once again, we had the PMI data that came out last week, the week before, weak for the most part, right? Not to seeing the acceleration. They did have inflationary data that was actually better than the street's expectations, but China's inflation is a little bit odd. The way that I wouldn't say it's odd. Let me not say that it's odd. Their culture is obviously different when it comes to consumption trends than ours, just inherently, right? So when you're seeing spikes in pork prices, beef prices, and chicken prices, that actually has a little bit more of a meaningful impact on how their inflationary setting looks than like oil right now. And then there's obviously still a little bit of lack of demand when it comes to the copper side of the equation. So I think this is more of a AI trade. Now, I look at Alibaba, I look at it on a weekly, you say, okay, it's basing out. It tried to attempt this 118, 120 level, kind of then faded back. It's literally been fading this level for the last 3 years. Is now the time? And that answer is going to be depending on what you're trying to risk. And so can it continue to rip higher? It could. The AI story can definitely be there, but understand that the AI story is probably going to be domestic driven. I don't foresee China's AI technology being readily accessible for the U.S. markets 6 months from now, 8 months from now. You can kind of see the writing on the wall. Usually, when you start banning, government agencies or even just NGOs from using certain technology, obviously there's a risk factor that is there, but that usually also then coincides with financial institutions doing the same thing, which you're starting to already hear about DeepSeek. You're looking at educational institutions, and pretty much then the writing's kind of on the wall there. So depends on how much access you think China's going to have. I think this tariff war is going to be a little bit more of a back and forth, but right now it's trading on a narrative. BABA, or if you're looking at FXI, it has been very depressed. The chart setup is there to say, hey, maybe it does rip. But this is one of those cautionary trades. And if the tariff war between China and the United States gets a little bit more aggressive, which I kind of believe that we might, even though I do believe that Trump will eventually capitulate as well as China. But I think right now we will have the theatrics. Be mindful of 2017, 2018. We actually took off a whole bunch of companies, China ADRs, in the United States market, and we labeled them as potential risk because they have ties to military, or the CCP, basically, CCP's military arm. So there's going to be ADR risk throughout this whole administration. So that's just something to be mindful of. But if you kind of look at it risk reward, yeah, I mean, why not? Until you hit these areas of resistance, what's the worst thing that's going to happen? And also, if you kind of look at it, you probably structure more of an options trade where you're buying long dated calls and then sell, looking at diagonal spreads, right? Sell out of the money, near term calls. And to try to reduce some of that premium. And then, once you get your rip, you take that short dated call, then you roll it out and make it just a long vertical. That's the way to kind of work these trades. And here's the thing too, BABA, no one gave any love to BABA. I was on a Spaces about a month ago, and I was like, look, do you think that they're going to have this China story at least come into the picture sometime this year? Yes or no? So BABA was trading at around $84, $85 at the time. And then, everybody's like, oh, China this, that, China that. And it's like, okay, well, if you went out to the December calls for BABA, for the 85s, or I believe it was the 90s, they're only going for like $6.
Yeah.
So it's kind of like, buy yourself some time. If you think that something can be a narrative driver throughout the year, buy some time and then just like sit on it. What's the word? You can lose all of your premium. Don't get me wrong. But I've lost $600 doing a lot of other stuff in easier ways than waiting a year for a narrative to play in. So that's how
that's the thing. You can, like you said, you can structure trades like that. And that's the thing that so many people, we talk trades, every single trade. And this is something that's not said enough. Every single trade you're ever going to be in your entire life is a risk. There is no risk-free trade. So, structuring it in a way that either you're doing it like me, where it's, hey, it's a percentage of your portfolio. It's only going to take this amount. I'm using a trailing stop, position sizing properly, or structuring it a way where, I have some calls on FXI, put them long dated calls, put them, leaps even, put them 6 months to a year out, sit on them for a long period of time, make sure it's risk managed properly. So you're only losing 1% or 2% of your portfolio if it does go to zero. But that upside should be big, like Kevin's saying. It's $600 to make possibly thousands.
Yeah, I mean that would have been a banger. I mean, and those are not leaps, but those are long dated. And those 85s are now going for what, 30 bucks intrinsic, give or take, right now.
So it's huge.
And then you have an IV spike. You have an IV spike that's also going to increase premiums because now everybody wants to buy. So that's just how it is. I know we got a do you have time for just really one more?
There's one more risk. We're good till 450-ish for,
Okay, cool. All right, let's talk about crude.
Let's do it.
A couple of weeks ago, what was it, about a month ago? A month ago, somebody was like, hey, Kev, you were bearish and yada, yada, yada. And they were calling me out and they were giving you props. And this is what's very good about our partnership, is because we look at completely two different things. And sustainability of price. You look at longer term trends. I look at literally week to week to even day to day. And $80 was an area of potential resistance, and rightfully so, we hit it. We hit $80. We went right above that, hit about $81. If you're looking at the weekly, you got.
And that's exactly what I told that guy. Is
Kevin, and he's a cool dude. And no, he's a cool dude.
Yeah,
actually love.
I
him.
love when people write in. It's more of us trying to explain. Hey, I'm on a long-term time frame. Kevin's on a short-term time frame. That's what we do here.
Yeah, I'm not calling him out negatively.
No, it's awesome.
Legit.
I love it.
He's legit. Yeah, I got to give him props. He's solid, actually, when it comes to his analysis as well. So what has happened? We pulled back here. demand side factors not really playing into effect right now. We had the EIA report today or yesterday. What is today? Wednesday? Is today Wednesday? Yeah, today's Wednesday. Okay. We had the EIA report that came out today. Nothing, we had a bigger than expected buildup when it came to crude oil inventories. A little bit of a draw when it came to gasoline compared to the street's expectations. Distillates built up. But once again, that was a demand side or a supply side issue that we were talking about. We were talking about this Arctic blast situation that was coming up. What was going to happen? The Bakken region was going to have potentially some issues when it comes to logistics, shutting down the Permian Basin or some areas in the Permian Basin because of weather events, Gulf Coast issues when it comes to winter weather, and literally no one moving anywhere. I was talking about Mississippi, like no one moved in Mississippi for like that whole couple of days when they had that. That's why you saw this price spike. But now you don't have the demand factors. You're seeing it pull back to the downside here, getting close to this range of $72 down to around $65. So keep your eye out on that. But the reason why I bring this one up,
Kevin's going to say, the reason why I bring this one up is to tell Jason how wrong he was and how right I was.
No.
I'm totally kidding because Kevin's not like that. We both give each other props, but I just made a joke.
Yeah, no, not at all. Not at all. And at the end of the day, you put trailing stops on yours. So, depends on how wide, like it was a good play. It actually, you can make the case, hey, it did actually make a higher high on a relative basis on that
we're still in the trade
coil. Yeah. So there's still something that's there, but I'm not saying it for that. So the reason why I bring this up for there's a little bit of a geopolitical risk that's not being priced into this right now. And so kind of depends on what President Trump says. I mean, the Israeli government kind of said something different. I'm going to distill this in a matter of 3 minutes here. So there's hostages that are supposed to be delivered on Saturday.
We're good. I've got about 10 more minutes.
Okay. Hostages that are supposed to be delivered or supposed to be kind of delivered on Saturday, right? This is Hamas holding Israeli hostages. Hamas came out and was like, hey, we might not be doing this because Israel is violating some of the terms of the ceasefire agreement. We're not going to get down to that road, but they're both violating their ceasefire agreements on both sides that have been documented and videoed. So it's okay. Like, I don't care what side of the spectrum you are, but let's just say this. They're both having some issues right now when it comes to the ceasefire. President Trump comes out and says, you know what, screw that, hold my beer. You don't deliver all of these hostages by Saturday at 12 o'clock. All hell's going to break loose. And I'm paraphrasing, but I'm pretty sure he did kind of say, there's going to be hell to pay or all hell baby break loose, right? Something to that effect, which is interesting, okay? Because what happens if they don't? What does that even mean? There's also like there's a news story that like we might be transferring the mother of all bombs to Israel. I don't know if that's actually true, but if that's the case, that's not a Hamas thing or a Gaza thing. That's probably more of a Iran thing. But let me just say this. So Trump says that, and it's like, oh, okay, what do you mean? Because Donald Trump is also coming back. We haven't done a thing in a long time. Apparently, the U.S. is going to be taking over the Gaza Strip. Did not have that one on our bingo card for this year. I can tell you that. Yep. And obviously, that's going to be some tit for tat and some issues there, just even logistically, or even if it is actually going to go down. That's huge. But if Donald Trump is true to his word, and he says, hey, you don't deliver all of them over the weekend, and he comes out and says some reckless stuff. I'm not going to say reckless. If he comes out and just says how he feels and is very aggressive, there's going to be a problem. That's an energy thing on your hands there. Now, Israel has come out. There has been a note that came out today and said, hey, as long as you just give us the 3 that you promised us, we're going to hold our end of the bargain. That's what they said. But, once again, President Trump seems like he has his own thing that he's trying to do. So if he doubles down on that commentary, 12 o'clock on Saturday might actually be, your make or break. And the reason why I say that this is actually being underpriced, the last time that we've seen this is actually the Yom Kippur War back in 1970s, right? And in 1973, what happened? We had the OPEC embargo. Now, will OPEC actually embargo the United States for crude oil? No, but it is a lever that they could pull if they wanted to slow down flows, because I highly doubt, unless you get Egypt and Jordan on board, which they don't sound like they really want to be on board, I highly doubt that this plan that Donald Trump has floated goes the way that he thinks it's going to go. And if they have to have some form of influence, the oil side of the equation could be it. Then you also have the reacceleration or resurgence of Red Sea attacks by the Houthis. You have Iran that's going to chime in. So there's some risk-reward. There's a risk-reward trade here that's not being priced in because obviously other factors are being bearish. That you want to keep on your radar, right? Like we haven't had this. I'm not even trying to exaggerate the commentary. We have not literally seen this since the embargo that we had that OPEC put on us. That's kind of the situation, how history rhymes. Is that as aggressive? Who knows? But history's rhyming right now. That could be a trade that's very underpriced. I'm not saying it's going to be a long-lasting one. And if they do deliver the hostages, you're probably going to see oil fail even more, right? It's probably going to sell off even more. But in the event that they don't, and something pops off, that could be something to be on your radar. So that's what I got.
And so real quick before we end, let's just talk about heating oil and gasoline. We are seeing a little bit of relative strength from both of these. You know, you and I have talked about heating oil being the one that we thought would probably be leading the way. It has so far really led the way. The pullback was actually pretty big in oil, heating oil, but gasoline actually is holding up really well. Heating oil is holding up really well for a pullback in oil and gasoline, or heating oil and gasoline. So what's your thoughts on the distillates? Do you think there's something there? There's something that could take this a little bit higher? Or do you think it's just something that's just kind of normally it just kind of catches up to crude oil and that's just it?
Yeah, so I would say like if you really wanted to get fancy with it, this probably wouldn't be a beginner or even intermediate retail trade. But if you wanted to get interesting with it, you trade spreads on these all three of these products right now, and you try to play the difference rather than trying to go outright because yes, there has been a meaningful difference between the performance of heating oil and gasoline. So for heating oil and the distillates and just in general, what we do actually have is our inventory levels in the United States are actually below the 5-year average that we are seeing right now. And right now is usually when we actually build up inventory levels. Now, you could say maybe last week, 2 weeks, maybe not. You have maintenance season. We had the utilization rates for refiners going to the downside. We had a meaningful pop in utilization rates today for the EIA report. But we do actually have an inventory problem when it comes to distillates, just in general. That we look at heating oil or diesel, whatever you want to call it, as that type of proxy trade. That is a thing. So let's keep that on the radar for sure. Gasoline, I don't know why the price has actually stayed elevated as much as it has because
that's the same to me. It's confusing. I don't know.
Yeah, the inventory levels. Yeah, the inventory levels hasn't. Well, okay. Let me say it like this: the inventory levels have been pretty high for gasoline. Now you can make the case. Okay, well, do we have any type of disruption of flows when it comes to heavy, which is not going to really impact gasoline that much? But then, do you have this distortion of refiners cranking out a lot of gasoline, but does that also then pull in demand for West Texas for a very short time frame? You're talking about 3 weeks, 4 weeks or so, right? That could be the thing. Maybe you also just have it where bears are just exhausted for gasoline, and they're just saying, and maybe that's the same thing for heating oil. Like, how much worse can it get? That could be the case too. I don't know. But what I can say is crack spreads have been looking very healthy right now. They're sitting at around $22. I haven't checked it today, probably a little bit less. Let me say $21 and some change. Crack spreads have been up over 26% year to date. What does that mean? That means 3 barrels of oil, converted into 2 barrels of gasoline, 1 barrel of diesel here. Profitability measures right now for refiners actually looks pretty good. If you're a refiner, do you want to see heavy crude or sour crude being impacted when it comes to flows? Technically, no. But profitability wise, yes, because then they're going to be able to ramp up prices. And obviously that's what you're seeing in heating oil, right? So profitability metrics, if they kind of stay in this $18 to $22 level for crack spreads here, and you look at a ETF like Crack, CRAK, or you look at Marathon Petroleum Company, MPC, or if you look at a Valero and you look at what crack spreads are doing right now, yeah, you kind of say, hey, do you actually take a little bit of a shot? You would have to wait another quarter to get their earnings, and some of them have already reported, maybe some of them haven't, but do you kind of look at this as a defensive play in the event that we do see some equity vol and this kind of flight to safety or flight to quality? It's a tough chart, but I kind of go with the profitability metrics and what the street's expectations are. So that's kind of how I look at it. And crack spreads can change on a dime, guys. So also be mindful of that. They can change on a dime. But the market right now, oil markets are really kind of priced again, some form of higher demand for heavy sour crude. Do we see an increase, a ramp up in imports? Right, that's going to be the question that we have. We have a ramp up in imports. That's going to be your kind of deciding factor there. Now, Marathon Petroleum has come out, because I don't want to make this, I don't want to skew this too much. Marathon Petroleum has come out and said, hey, if we have to and we needed to utilize more light sweet, we can with the refining infrastructure that we have right now. Now, be mindful that will also require additional chemicals in order for them to do so. But they said that they would not have a major disruption of flows if we did see an impact when it comes to heavy crude. And tying it back, we go back to this issue over in Gaza and Israel, right? Like that's one of those levers that if Saudi Arabia is not feeling it and Jordan's not feeling it and Egypt's not feeling it, and they say, hey, dude, like, listen to us, we're not going to take these people in. We don't want to do this. People don't want us to do this. And you see this tit for tat, they can come back and they can come back and say, hey, dude, like, we could slow down flows. We could slow down your imports of heavy. You know, we've seen it before.
Interesting. Yep. So no, like, that's great, and great way to wrap it up. A lot of actionable insights here. Keep those on your radar. And also, you know, looking at gold. You know, we talked about gold earlier. Silver, went through some of the commodity sector. So want to thank Kevin for coming on. And we'll see you guys soon. Somebody did write a comment. Oops, I missed it. I was on the other page. Uncorrelated to U.S. natural gas. You know, sometimes, yes, natural gas does whatever it wants to do. So that's a simple answer to natural gas. I always call it the exorcist because it does whatever it wants. So, all right, guys. Thank you guys for hanging out with us. We'll see you guys soon.